Shanghai just turned the lights back on. 8 days dark. 8 days while Western paper ripped from $88 to $94 on war headlines. 8 days while the mainstream financial media told you this was a geopolitical spike, temporary, emotional, faded on the news. Here's what they did not tell you while Shanghai was dark. Comex registered silver, the metal that actually exists in vaults and can actually be delivered, sat at 86.13 million ounces going into March 1st notice day. And 52.63 million of those ounces were already standing for immediate physical delivery before the first trade of the month printed. That is 61.1%. Before a single Western trade executed on March 1st, 61% of every deliverable ounce at Comex was already spoken for, and Shanghai just opened. OG John AG here. This is financial warfare education, not advice, not hopium, not a signal service. We go through the data precisely. We cover the bear case fully, and we give you the exact numbers and the exact sources so you can verify everything with your own eyes tonight. Let's break it down. Segment 1, the disclaimer and the mission. Before we go 1 second further, the standard, because it matters more than ever when the market is moving like this. I sell nothing. No courses, no Discord, no Telegram, no signal groups, no private mentorship, no affiliate links, no paid tiers. If anyone contacts you claiming to be OG John AG or Team OG John AG outside the single official email address in the description, it is a scam. Screenshot it and report it immediately. These people prey on the same community I am trying to educate, and I take that seriously. You find me here on YouTube and on X. That is it. That is the whole operation. Now, what this channel does is show you the mechanics, the primary data, the historical precedents, the live tape, so that when Monday opens and the algos paint the move as nothing but a Middle East war bid, you already know whether the structural case underneath that war bid is real or whether it evaporates with the first ceasefire headline. Tonight, the structural case is real. Let me show you exactly why. Segment 2, where we actually are right now. Let me put the precise numbers on the table, because precision is the only thing that separates education from noise in a market moving this fast. Western spot silver, $94.50 as of Sunday night, March 1st, 2026. That price represents an 8% single session gain from Friday's open near $87.75. Silver's average daily move in a normal functioning market is 1% to 1.5%. An 8% move is 5 to 6 times standard daily volatility in one session on a Friday. Before a weekend when Comex goes dark. Gold closed Friday at 5,278.20, up 1.82% on the session. Silver moved more than 4 times gold's percentage gain in the same session. That ratio of silver outperforming gold 4-to-1 in a crisis event is not random. It is the signature of a physical market that was already tight before the first missile was fired over Tehran. Gold goes up in a crisis because it is a safe haven. Silver goes up 4 times faster than gold in the same crisis because it is a safe haven sitting on top of a pre-existing physical supply emergency. Those are 2 completely different situations. Most of the coverage you are seeing this weekend is treating them as the same situation. They are not. Now, the Shanghai data, before the Lunar New Year closure, Shanghai Futures Exchange silver was trading at a premium of $10 to $12 equivalent above Western spot. That was when Western spot was $88 to $90. During the 8-day blackout, while Comex was running on war bid momentum, Shenzhen recyclers and physical industrial buyers were posting bids of $95 to $96 equivalent, cash bids, for physical metal. Not paper contracts, not futures, cash for ingots and scrap. Western spot at the time, $94.50. The physical cash market in China was bidding above Western paper during an 8-day period when Shanghai was completely closed for Lunar New Year. The physical market did not need the exchange to be open to tell you what real silver is worth to a real industrial buyer who actually needs the metal. Shanghai just reopened. The recycler bids coming in before the bell were $95 to $96 equivalent. That is not the post-holiday catch-up premium everyone expected. That is the physical market confirming that the price discovery mechanism in the West has been running behind physical reality, not ahead of it. That is the position. Now let's talk about why. Segment 3, Engine 1, the Comex liquidity trap. Pull the CME Daily Stocks Report dated February 27th, 2026. It is public, free. Takes 4 minutes to find. Here is what it shows. Registered silver, and I want to be precise about what registered means because this distinction is everything. Registered silver is the metal sitting in approved Comex vaults that has been warranted for delivery. It has a warehouse receipt. A futures contract holder demanding physical delivery can claim it tonight. Eligible silver sits in the same warehouses, but it has not been warranted. It cannot be delivered against a futures contract without the owner converting it to registered status first. Shorts cannot reach into the eligible pile and force delivery. That is not how the mechanism works. Eligible is not a reserve buffer for the delivery system. Registered 86, 130, 399 ounces as of February 27th. That number was 167 million ounces in October 2025, 4 months ago. 167 million. Today, 86 million. That is a decline of 81 million ounces, nearly half the registered inventory in 4 months. Not a data error, not a seasonal adjustment. A sustained, consistent, month-over-month drain of real metal out of the deliverable pool. Now layer in the delivery notices. March contract standing delivery notices as of first notice day, 10,526 contracts. Each Comex silver contract is 5,000 ounces. 10,526 contracts times 5,000 ounces equals 52.63 million ounces standing for immediate physical delivery. Divide 52.63 by 86.13. That is 61.1%. Before the first Western trade of March executed, 61.1% of every ounce that can legally be delivered at Comex is already claimed by someone demanding real metal, and the drain did not stop over the weekend. The latest 24-hour withdrawal data shows another 1.13 million ounces pulled from CNT, Delaware, HSBC, and JP Morgan vaults. The registered number is moving lower, while the delivery demands are moving higher. Here is what that math means in plain language. If the historical delivery completion rate holds, if somewhere between 5% and 10% of standing notices actually go through to full physical delivery, the system handles it. That is 2.6 to 5.3 million ounces of actual metal changing hands out of 52.63 million standing. But here's the variable that historical averages do not account for. The historical delivery rates were set in a market where physical buyers trusted the system, where they were willing to accept cash settlement instead of metal because metal was available if they wanted it. When physical buyers stop trusting cash settlement, when they look at the registered inventory and the withdrawal rate and decide they want the actual ounces, the historical 5% to 10% completion rate becomes meaningless. We are watching the completion rate expectations shift in real time. Shanghai physical buyers are not accepting Western paper prices as real prices. They are bidding $11 above spot for physical metal before the exchange even opens. That is not a buyer who is planning to cash settle. In November 2025, when the Comex cooling system halt hit on first notice day and silver was at $53, the registered inventory was 40% higher than it is right now. After that halt, after the delivery pressure proved real, silver doubled in 2 months. We are in that exact structural window again, with 40% less registered inventory available and 61% of it already claimed on day one. That is not a forecast, that is arithmetic. Segment 4, Engine 2, the Shanghai reopening. Let me explain precisely why the Shanghai reopening tonight is not just another data point. It is the moment the structure either holds or breaks. For 8 days, Western paper had a monopoly on silver price discovery. Comex was the only major exchange running. And during those 8 days, Western paper moved from $88 to $94 on war headlines. Shanghai was dark, but the physical market was not dark. Shenzhen recyclers, the companies that buy physical silver scrap and ingots and process it for industrial use, were posting cash bids of $95 to $96 equivalent per ounce while Shanghai was closed. These are not speculators. These are industrial buyers whose factories stop running if they do not have physical silver. They do not post 95 bids on $94 paper because they enjoy paying premiums. They post 95 bids because that is what physical silver is actually worth to them right now. The premium never closed during the holiday. That is the key signal. When an exchange closes for a holiday, you expect the premium to compress because the physical urgency is reduced. Factories slow down, procurement teams take time off, industrial buying pauses. None of that happened. The physical bid stayed elevated through 8 days of holiday blackout. The factories needed metal. The recyclers were buying. The premium held. Now Shanghai reopens into a Western price that caught up to $94 to $50 during the holiday. But the Shenzhen recycler bids before tonight's bell were already at $95 to $96 equivalent. That means the premium is not compressing on the Shanghai reopening. It is holding. The physical market is telling you that $94.50 Western spot is not expensive relative to physical reality. It is not a war premium that needs to be faded. It is Western paper catching up to where the physical market has already been. Watch the Shanghai opening price in the next 2 hours. If Shanghai opens at $105 to $106 equivalent, the arbitrage window stays wide open. Physical silver flows east because it is worth more in Shanghai than it costs to buy in London or New York. That flow accelerates the Comex registered drain. The 61% standing delivery becomes harder to ignore by Wednesday. If Shanghai opens at parity or below Western spot, that tells you the holiday premium was temporary and the physical urgency is lower than the recycler bids suggested. That would be a meaningful bearish signal for the near-term structure. Watch that opening print. It is the most important single data point of the next 24 hours. Here is the structural context. Before the Lunar New Year closure, Shanghai silver was trading at a $10 to $12 premium above Western spot when Western spot was $88 to $90. That means Shanghai was pricing physical silver at $98 to $102 when the West said $89. During the holiday, Western paper ran to $94.50. Physical Shenzhen bids ran to $95 to $96. The West almost caught up to where Shanghai was before the holiday. Almost. Not quite. If Shanghai opens tonight, anywhere above $105, the arbitrage is still alive. Physical is still worth more in the East than the West. Silver continues flowing east. Comex continues draining. The paperboys needed Shanghai to stay closed. They got 8 days. Those 8 days are over. Segment 5, Engine 3, the geopolitical cover, now the geopolitical engine. And I want to be precise about how this engine interacts with the other two, because this is where most of the weekend analysis goes wrong. Confirmed. U.S.-Israeli joint operations, Operation Epic Fury and Operation Roaring Lion, executed coordinated precision strikes on military infrastructure across Iran, including missile program sites. Confirmed. The Strait of Hormuz, 21 miles wide, 20% of daily global oil supply in transit, facing active disruption. Iranian naval forces declared restricted passage. Tankers diverting. Confirmed. OPEC emergency summit called. Oil moving toward $100. Now here's the silver-specific implication that the mainstream coverage keeps missing. Silver is not gold. Gold is a pure monetary metal. It responds to safe haven demand, and that is the primary lever in a geopolitical event. Silver is a monetary metal and an industrial metal simultaneously. During a geopolitical crisis, those two demand signals fire at the same time. Safe haven demand, investors rotating out of equities and dollars into metals. This is what drove gold's 1.82% move. Industrial demand preservation. When oil moves toward $100, supply chain input costs rise across every manufacturing segment. Solar panel manufacturers, EV battery producers, electronics companies, defense contractors. All of them run procurement models that tell them to buy industrial inputs before the supply disruption cascades through their cost structure. They are not buying silver as a safe haven. They are buying it because their models say buy now before the price goes higher and the supply gets tighter. Both fired simultaneously on Friday. That is why silver moved 4x gold. But here's the critical point about how this engine interacts with the other two. The geopolitical engine is the most volatile of the three. It can reverse on a single diplomatic signal, a ceasefire framework announcement, an OPEC production response, a back-channel statement from Gulf state intermediaries. Any of those can deflate. The war premium component of Friday's move quickly. Geopolitical spikes in commodity markets historically fade within days to weeks unless the escalation sustains. The Comex liquidity trap does not care about a ceasefire. The Shanghai physical premium does not disappear on a ceasefire. The 61% standing delivery notices do not go away on a ceasefire. The geopolitical engine provided the timing signal that brought institutional capital off the sidelines. The structural engines are what keep the move alive after the headlines change. This is why the mainstream analysis is incomplete. They are covering one engine, the one with video of missiles and oil tankers. The other two engines are running in the background whether or not Tehran is trending on X tonight. Segment 6, the technical picture. Let me walk you through the specific levels because these are the numbers that tell you whether the structure is holding or breaking in real time on Monday. Silver has been forming a textbook ascending channel on the 4-hour chart. Higher highs, higher lows. Each pullback holds above the previous pullback low. Each rally makes a higher peak than the previous rally. This is not a one-session spike structure. This is a sustained uptrend structure that has been building for weeks. The key level, 91.33. This was horizontal resistance, a price where sellers overwhelmed buyers on multiple previous tests. Friday's session broke through it convincingly. When resistance breaks on volume and holds on subsequent tests, it becomes what technicians call a flipped level. Former ceiling becomes floor. 91.33 is now the floor of the bull thesis. As long as silver closes each daily candle above 91.33, the ascending channel is intact. The 104.14 target, where the upper boundary of the channel projects based on weeks of established slope and width, remains valid. A daily close below 91.33 does not end the bull market, but it tells you the near-term channel structure has been damaged and a deeper retest is underway. Watch every daily close against that level starting Monday. Immediate resistance cluster, 95 throws rare. Round numbers attract both buyers who want exposure before the level breaks and sellers who take profit at psychological targets. The price action around $95 will be noisy. Expect wicks, reversals, stop hunting above and below. A decisive hourly close above $95.80 with volume behind it opens the path toward $97.50, then the big psychological level at $100. If hourly bodies close back below $92.80, not wicks bodies, that tells you the war premium is being faded aggressively and shorts are reloading. That is the pattern to watch in the first hour of Monday Western Open. RSI on the 4-hour chart is hovering near 70. That tells you two things. First, buying pressure is extreme and sustained. RSI near 70 is not a slow drift upward. It is consistent aggressive buying across multiple sessions. That is bullish momentum confirmation. Second, the market is entering territory where short-term exhaustion is a real risk. RSI near 70 does not mean sell. It means expect violent intraday swings, stop hunting in both directions, and brief sharp reversals that test conviction before the next directional leg. The options market is telling the same story. CME silver implied volatility is above 100, higher than when silver spiked to $120 in January. The options market does not care about headlines. It prices the mathematical probability of large moves. Right now, it is pricing violent moves as more likely than at any point this year. That cuts both ways. Explosive upside and explosive downside are both inside that implied volatility number. $91.33 below, $104.14 above. Those are your brackets. Segment 7. Harry at the coin shop. Let me bring this from the technical levels down to ground level, because the ground level is where the real confirmation lives, and it cannot be faked with algos or paper orders. Harry at your local coin shop opened Friday afternoon before the full scale of the geopolitical developments had cleared. By the time he locked up for the weekend, his front case was a different place than it was Monday morning. American silver eagles, gone, not reduced, gone. Mercury dimes, gone. Pre-1964, 90% silver, selling instantly at any premium, he quoted. Backroom, sterling silverware backing up. Bulk junk silver with mixed dates sitting. Refiners delaying pricing on scrap. They cannot give Harry a quote because their own input costs are moving too fast for them to hold a price for 24 hours. That split, front case empty, back room backing up, is not a weekend anomaly. It has been the consistent picture for weeks. The retail physical buyer wants eagles and recognizable coins. The industrial buyer wants deliverable grade silver. Both channels are strained. Neither channel is flush with supply. Harry opens Monday morning. He sees $94.50 on the chart. His phone rings before he finishes his coffee. People who have been sitting on the sidelines for months asking, "Do you have eagles? Can I come in today?" His answer for a significant number of those calls, no. The online dealers are not going to save those buyers either. AppMex, JM Bullion, SD Bullion, they are going to be either sold out of key products or repricing premiums to reflect a market where every buyer wants in and no seller wants out at yesterday's price. The CoinShop reality is not a chart level. It cannot be CME halted. It cannot be algorithm painted. It is a transaction between a buyer who wants metal and a seller who is running low. And right now that transaction is resolving at higher prices or not resolving at all. That is the physical confirmation that the data has been pointing toward for months. It is playing out exactly where it was always going to play out. Not on a screen, but across a counter. Segment 8, the honest bear case. Now the other side, full treatment. Because this is financial warfare education, and the bear case on this specific setup deserves exactly the same precision as the bull case. The geopolitical premium is the most dangerous variable in Friday's move. Geopolitical spikes in metals have a consistent historical pattern. Violent spike on the event, sustained if escalation continues, rapid deflation if diplomatic signals emerge. Most geopolitical premiums in silver resolve within days to 2 weeks. If back-channel ceasefire talks produce even a temporary de-escalation signal this weekend, a framework, a pause, a Gulf state intermediary announcement, the war component of Friday's 8% move could give back 3% to 4% on Monday morning alone. The January 30th crash is 4 weeks old, 31% in a single session on the Warsh nomination headline. If you bought near $121 that day, you are still underwater at $94.50. Silver does not apologize for violent reversals. The same high beta characteristics that gave it 4x gold on the upside will give it 4x gold on the downside when the selling pressure arrives. RSI near 70 combined with a gap up open creates a specific technical risk called the buy the rumor, sell the news reversal. The professional pattern runs like this. Price gaps up at the open, retail buyers flood in expecting continuation. Institutional sellers who positioned earlier in the week take profit into the retail buying, price fills part of the gap. Weak hands get stopped out, then the move resumes if the structural case is real. The gap fill back toward $91.33 is not the bull thesis breaking. It is the normal technical sequence in a high volatility market. But it will feel like the thesis is wrong when you are watching it happen in real time, and it takes conviction to hold through. CME has tools it has not used yet. Margin hikes, position limits, Liquidation-only orders. These do not resolve the physical reality, but they can compress the paper price in the short term. They have been deployed in stressed silver markets before. Watch for emergency CME announcements in the first 2 hours of Monday open. March roll mechanics. Some of the 52.63 million ounces standing for delivery will roll to May. Historical roll rates suggest a meaningful percentage of standing notices convert to cash settlement or roll forward rather than taking physical delivery. If the roll rate is higher than expected, the immediate delivery pressure appears to ease, even if the structural drain continues. Shanghai could open softer than recycler bids suggested. If institutions take profits after the 8-day holiday gap, the opening print could disappoint relative to the $105 to $106 expectation. A soft Shanghai open would remove the arbitrage urgency and give paper sellers a window. All of this is possible. Every single one of these scenarios can play out while the structural case remains intact underneath. A 3% to 4%. Monday reversal does not break the ascending channel if 91.33 holds on a daily close. The bear scenarios are real. They are not reasons to ignore the structural engines. They are the reasons you watch the specific levels instead of watching the headlines. Segment 9. What to actually watch here is your specific watch list for the next 48 to 72 hours. Everything on this list is public and free. $91.33 daily close. Every single daily candle. As long as silver closes above this level, the ascending channel is intact and 104.14 remains the structural target. A daily close below 91.33 means the near-term structure has broken and a deeper retest is in progress. Shanghai opening print tonight. Compare it live to Western spot $94.50. If Shanghai opens above $105, arbitrage is alive, physical flows east, Comex drain accelerates. If Shanghai opens at or below Western spot, the holiday premium was temporary. The gap will tell. Everything within the first 30 minutes of the Asian session. $95, $80 Monday open. Hourly body close. Not a wick, a body. If Western silver prints a decisive hourly body close above 95.80 in the first hour of Monday trading, the path toward 97.50 and then $100 is opening. If it opens above $95 and then hourly bodies close back below $92.80 on volume, that is the gap fill pattern and the war premium fading simultaneously. Comex registered update Monday morning. CME publishes vault data daily. If Monday's print shows registered silver below 86 million ounces, the drain is continuing simultaneously with the geopolitical event. That combination is the most structurally bullish scenario for the $104.114 target. SLV premium to NAV. When SLV trades at a discount to net asset value, authorized participants redeem shares for physical and deliver against shorts. Watch whether SLV is trading at premium or discount in Monday's pre-market and opening hour. Premium means retail is buying paper. Discount means the banks are quietly extracting metal. Oil and WTI Monday action. If WTI crude crosses $100, Hormuz disruption is being priced as sustained. That keeps both safe haven and industrial demand components of silver's move active simultaneously. If oil pulls back hard from current levels, the geopolitical premium in silver will be under pressure. Diplomatic signals from Tehran, Jerusalem, Washington, or any Gulf state intermediary. These are the primary risk to the geopolitical component, not the technical levels, not the CME tools. Watch for any statement framing de-escalation before Monday open. Let me put the full picture on the table one final time. 3 engines, all 3 running simultaneously, independently. Engine 1, Comex liquidity trap. 86.13 million ounces registered. 52.63 million already standing for delivery. 61.1% claimed on day 1. 1.13 million ounces drained in the last 24 hours alone from CNT, Delaware, HSBC, and JP Morgan. The inventory is not refilling. The paper to physical ratio is not normalizing. Engine 2, Shanghai physical premium, 8 days dark. Physical bids at $95 to $96 equivalent while the exchange was closed. Shanghai just turned the lights back on. The recycler bids before the bell were already screaming. The premium never closed. Watch that opening print. Engine 3, institutional target revision. Deutsche Bank signaling upside risk to their $100 target. Eric Sprott publicly warning of a $300 revaluation shock when 6 years of structural deficit collides with the paper leverage unwind. Major bank models updating simultaneously. Those revised targets have buy orders sitting behind them. Those orders execute Monday when the gate opens. 91.33 is the floor, 104.14 is the channel target. Those are not made-up numbers, they are the structure. The cover story is perfect right now. War headlines, oil spiking. Every mainstream screen will say silver is ripping on Middle East news, and some of it is. The geopolitical component is real, but the 86 million ounces registered does not care about headlines. The 61% standing delivery does not care. The Shanghai premium does not care. The data is not asking permission. It is telling you the paper pricing mechanism is fracturing in real time. The question is whether you are reading the data tonight or waiting for CNBC to explain it to you after it has already moved. Pull the CME daily stocks report yourself. Check the Shanghai opening price yourself. Track the SLV premium discount yourself. The sources are free. The data is public. The pattern is clear. The informed minority sees the disconnect. The majority reacts after the fact. That is how every major move in this cycle has started. This is financial warfare education, not advice. Do your own research. Verify everything I have shown you with your own eyes. Manage your risk like your future depends on it, because it does. And never confuse a paper price with a physical reality. If you watch this far with your brain turned on, drop OG John AG in the comments right now and tell me, is the Shanghai opening print confirming or denying the physical premium, bull or bear on 91.33 holding through Wednesday? OG out.